Hello and welcome to the February 2023 Advanced Projections Economic Report. First, I'll start off with a fast apology. We are out a couple of days late this month as we were waiting for CPI data and a few other things from the Federal Reserve before we published our final report for the month. So let's begin. Let's review the economic data highlights for January and the first half of February 2023. Employment figures for January came in with an amazingly high new jobs figure, up 517,000, and unemployment moved down to 3.4%. This is dead center in the target zone we predicted last year of 3.3 to 3.5%. It took a little longer than we expected and now shows little sign of reversing trend yet. However, we expect that unemployment should eventually begin to gradually move upwards because at these low levels the Fed must stay fully focused on inflation, given this fresh ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through January was announced on February 11th, with consensus expectations for it to be around 6.3%. The actual reported value was 6.4%, just above the expected range. However, sticky price inflation, less food and energy, continued to rise in December to 6.61% and moderated insignificantly in January to 6.55%. This is still more than 1.5% higher than 8 months ago and is still higher than the more general CPI number. The Federal Reserve added another 25 basis point rate increase to their Fed funds rate, now at 4.5% plus on February 1st. In mid-December, they issued new projections for 2023 through 2025, and they are now looking for a longer fight against inflation with higher rates than they projected previously in 2022. The hot employment picture seems to confirm that scenario. Equities markets have gained as much as 10% since the October lows were put in, but are testing key resistance levels, and volatility indices are pointing at another move downward. The S&P 500 has been testing overhead resistance around 4,100, where it crossed its 200-day moving average, and the overzealous market response to the previous 6.5% CPI reading and the Fed's less than zealous 0.25% rate hike briefly fueled another brief leg up in the temporary bear market rally, but the overheated employment report cut short that exuberance. With the inflation figures out on 2/11, equities traded calmly but are likely to resume their downward trend once the Fed's next open market committee moves and comments are digested, coming out right after another such report in March, quickly followed by the Fed's next FOMC moves on interest rates. Our indicator system keeps our recession risk level at 90% plus, due to more steeply declining leading economic indicators, a continuing hawkish Federal Reserve monetary policy stance, and an ever-deepening red APYC yield curve indicator. There are now no AP indicators showing green, and only one, the AP Stock Index indicator, is just skirting the boundary between red and yellow. 1 year ago, in early February of 2022, advanced projections gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program in that March. Here in 2023, a year later, there is continuing evidence of significant moves to cash as reflected in the long-term bond market, as people are realizing the resolve of the Fed in their long game battle against the inflation dragon. Some of that cash has fed temporary bounces in equities, but that is not likely to stand up against all the true forces at play elsewhere in the economy. Here are the current underlying economic details. Year-over-year consumer price index increases still resolving supply chain issues, and very tight labor markets continue to affect many aspects of the economy. General expectations out just ahead of the January CPI announcement were for 6.3%, but it came in around that at 6.4%. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down, and home energy costs will likely have an upward effect on readings in months December through March. The Bureau of Labor Statistics employment and the Federal Reserve's intentions, as unemployment continues to remain well below 4% in the past 11 months, now at 3.4%, with new job gains in January of 517,000. We had expected those gains to dwindle in the first few months of this year, but no evidence of that happening just yet. We still expect to see an accelerating pace of layoffs begin by late spring of 2023. We have, in this report, we've omitted the usual Bureau of Labor Statistics Summary Table A from this month's report due to an incomplete presentation and their corrections for population growth effects. So next month we should show a normally configured table. We have, however, included a link to the BLS report so that readers can see, what's going on there. The currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, along with their 8 rate increases in the March 22 through February 2023 timeframe, and within their latest available FOMC meeting minutes. Look for continued activity in these areas when the Fed returns with their next steps at the end of January. Their December and February rate increases came in 25 basis points below our expectations, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part in the beginning of this year. Expect at least a 25-point bump in mid-March, perhaps as much as 50 points, if they lend more weight to the still climbing employment and sticky inflation values. We've included a table issued in their December 22 report that shows exactly why to expect continuing Fed hawkishness. Note all their projections made in September have been uprated in December to show higher interest rates and longer-lasting inflation than they had previously thought. Higher rates for longer means more braking on the economy, and they indicate more than a full percentage point higher unemployment from current levels as a consequence. Something to also take note of in the Fed's speeches and comments: do not confuse disinflation with deflation. Disinflation simply means that the rate of inflation is slowing down. It does not mean prices are going down. It means the rate of increase is simply slowing. Deflation means that prices are going down, and we are not experiencing that in most areas. In the energy picture, in 2022, the June through November 0.75% interest rate increases had already had a significant effect on the price of oil, driving it down more than 40%. This was in spite of OPEC and Russia cooperating in agreement, both financially and politically motivated, to restore their 2 million barrel per day production cuts to levels which were enforced during the first quarter of 2022. Global demand forecasts are having a greater negative impact now, with oil moving above and then again below $80 a barrel in the past 30 days. Gasoline prices are likely to temporarily push north of $4 per gallon during the spring, here as a higher than usual number of refineries will enter their maintenance shutdown periods. This will probably amplify the normal yearly spring refinery price bump. Natural gas prices may end their pricing breather that resulted from a fire at the Freeport, Texas export facility. However, that facility has not fully returned to service, and a warmer than predicted heating season has depressed demand somewhat. Once the Freeport facility returns to full production, LNG export activity will be back near maximum. That will also pressure electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. Gas prices should soon reflect the expectation for restored export activity, especially if more major winter weather hits before the arrival of spring. California, the second largest gas-consuming state, recently experienced record-high natural gas prices at many multiples higher than the rest of the 48 states. Daily consumption there recently hit a record high of 140 billion cubic feet per day during their last cold snap. That's the national figure, by the way, 140 billion cubic feet per day. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. On the supply side for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and 2021, and will put them into production over the coming months. So there are no real supply issues, and the gas that was stored away for winter use in underground reserves are at higher than usual levels because of a warmer than usual heating season. So supply side, there really isn't an issue right now. Equities. The recent lower CPI report of 6.4% injected a little short-lived euphoria into the markets, but fresh negative news in the form of 517,000 new jobs restored the downtrend. We continue to expect significant further declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3,000. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation, when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes should still be expected, with the next one in mid-March of this year. They have clearly stated what their targets are, that inflation has not truly begun to respond as needed, and they are dead set against pausing or quitting too early. We have a long-term chart with actual analyst projected values for S&P 500 earnings and revenue growth from 2017 through 2023. Our markup shows where we think they have miscalculated, similar to what we did for the middle of 2022 in past months. The first test for the analysts will be when complete fourth quarter 2022 earnings are out in this time frame. If they miss expectations en masse, it becomes more certain that 2023 will be weaker than currently expected. Fourth quarter 2022 corporate earnings for the S&P 500 outside of the energy sector will likely show an aggregate negative growth of about minus 5%, possibly more. Those numbers continue to come forth even as this report is issued, so a much better picture of earnings will be found in our March report due out in about 4 weeks. If they show the declines we expect to see, then the equity indices should resume their declines as well. We'll provide an updated version of this chart showing the actual results for 2022, including what we expect from the depressed fourth quarter results merged into the full year's numbers. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The December number, it's always 1 month behind the reporting date for this metric, is down another 5.8%, bringing the full year's decline for 2022 to nearly 40%. Risk capital has made a serious exit from the markets. An equity market bottom may be near on a historical basis when margin borrowing declines a full 55% from its previous high. So there is still the potential for a further decline of around $750 billion in margin borrowing to reach that point. We have included a monthly chart again, courtesy of one of our favorite sites, Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.